This will give you what you need, and you got that 80% probability of winning on this trade. 80% chance. So you gave yourself a lot of wiggle room to be able to deal with it. So let's say on Monday the market goes down too much or it goes up too much. Well, you'll still have a day to be able to adjust. Right? You'll adjust it, move it out, give yourself another couple days, whatever the case may be, and you will be fine with this trade, giving yourself another 80% chance of winning. You have one more type of big adjustment like this that you could potentially do because you're allocating 6,000 and you only use 4,000 to this point. So just keep that in mind with this type of trade. Let's talk about short-term trading and trying to collect a certain amount each time you do a 1 to 7 DTE type of trade, but primarily the 1 DTE trade. We do that quite often, is that 1 DTE trade. It's some problems inherently within the 1 DTE trade that you have to be worried about or concerned about or vigilant about, and that's the overnight risk. Something can happen overnight that you do not have an opportunity to fix until the next morning. It's very, very rare, but you still need to consider that that's a possibility. And you always have to be considering your risk when you are doing any type of trade. But when you're doing a 0 DT trade, you have the most gamma risk. You have that most directional risk of things changing. But you do not have any overnight risk. You get to see what's happening that day, and then you make your adjustments accordingly, or you take your loss, or obviously, preferably, take your profit. So the 0 DT is attractive in that aspect because it can give you the biggest type of returns because it has the most type of risk when I'm talking about options trading.
Please subscribe to and happy Chitty Ninja Coins.
The 1 DT trade can give you the second biggest type of returns, but it has less gamma risk than the 0 DT trade, but it does have that overnight risk. So it's trade-offs with all these type of short-term trades, or it's trade-offs with any type of strategy, any type of trade. If you're doing something longer term, you have no gamma risk, but it takes longer for you to realize your profits. It's a longer process, and that's fine if that meets your temperament. You guys know we've been talking about that quite often recently. But what's attractive to me is the concept of being able to consistently try to make $100 a day on short-term trades, and you can do that with a 0 DT trade, you can do that with 1 DT trade, you can do that with a 7 DT trade, you can do it on all these different type of trades. But I like the 1 DT trade, and that's basically a 3 DT trade today. And this is one of the best times that I've noticed you should be able to do it. I know you have more than overnight risk. You got two nights in between before the market opens, and you have Saturday and you have Sunday type of risk. But the market kind of factors that in to a certain degree almost all the time, and it's usually overstated, the volatility. So Mondays are usually a good day, in my opinion, to be able to do these type of trades. But if you're going to make this some type of consistent trade for you, then you should consider, if you have a smaller account, you should consider the 1, 2, 3, 4, up to 7 day type of trade, and allocate some capital to it. So for example, in this account, we're allocating 6,000 to this strategy. And so we would normally do a spread no wider than 20 points wide. And that's going to use, let's just say, $2,000 of buying power to do. Well, if we have to add another contract, then that's going to use $4,000 in buying power. And if we have to adjust and add another contract, then that's going to use $6,000. Just basically, I'm not including the credit, right? Because it's actually going to be a little less than that if you include the credit. But that gives you wiggle room, gives you options to be able to maneuver the trade if something goes wrong. If something goes wrong. I've been trading these 1 DT type of trades for this entire year, and we've never had a trade go into the money. One time it was close, but we never woke up the next morning with the trade in the money. But that doesn't mean it's not going to happen later on. Doesn't mean it's going to happen later on. So if you want to avoid that potential overnight risk, maybe you do 2 days to expiration trades. Maybe you do 3 days expiration trades. You can still get out of them fast, perhaps. Just like you've noticed, we got out of that 4 DT trade that we did yesterday. We got out of it today. So it's really just a 1 DT trade. We got 60%, 63% that we just rang the register on. So it could happen. Obviously, the trade can go the opposite way for you, and you in it, but you still have more options when you go a little further. Right? I'm not talking about bread and butter 30 to 60 days, but if you do 2 days, 3, 5, 7 days, something like that, if the market goes against you, you have the ability to adjust within each day and not get day trades and still be able to potentially win down the road, especially if you're trading it super small. So if you're allocating $6,000 to this trade, and let's say you had $10,000, but you're allocating $6,000 to this, well, you're going to have the ability to adjust at least 2 big adjustments. And I'm talking about rolling out. I'm not including the rollaways that we normally do. I'm talking about rollouts and adding another contract. So for example purposes, let's just say if we had a trade on today that was going to expire, and I know this is a bad example because this is really late in the day, but I'm just going to try to show you anyway. Let's just say that this was the trade that we had on, and it was a 20-point wide spread, which will look like this. And let's say you're uncomfortable with this trade, which you should be. This is only going to be $200, but let's just say it was because we made this adjustment earlier on. Let's say it was $400. Okay, let's just say it was $400, and the put side was zero. Okay, it was basically zero. So let's say you need $400, and you're going to roll this out to, let's say you're going to roll it out 4 days. And so you go over here, and let's say you go to this 16 delta on the call side, and you do a 20-point wide spread. And you go to the put side, and let's say you do the 10 delta here, or let's just say the 14 delta here, and you do a 20-point wide. Right? So this right here is giving you $380. We need $400. So let's say we decided, because we have the ability, because we trade in this small, we can add another contract. So now we're getting $760, and we only need $400. So now you can decide to move this away to give yourself higher probabilities. Right now, the probability is saying 71%. What if you can get it closer to that 80%? Right? So if you can get it closer to that 80%, that'd be great. The call side was the problem, so that just moved this call side to here. And so now that's $680. The put side wasn't, so maybe the market reverses. So you want to move this put side down some. Let's say you move this put side to the 10 delta here, and you did a 20-point wide spread. You're still getting 560. You need 400 in the example we're talking about. Okay? And but you're at that 77% probability, closer to that 80%. If we move the put side again, and that's 520. And let's just say if we move this call side one more time, and so now we needed 400, we're getting 450 here. You can decide to do this or do the trade, or do the adjustment we just finished, right, just before this one. But this will give you what you need, and you got that 80% probability of winning on this trade. 80% chance. So you gave yourself a lot of wiggle room to be able to deal with it. So let's say on Monday the market goes down too much, or it goes up too much. Well, you'll still have a day to be able to adjust. Right? You adjust it, move it out, give yourself another couple days or whatever the case may be, and you will be fine with this trade, giving yourself another 80% chance of winning. And you have one more type of big adjustment like this that you could potentially do, because you're allocating 6,000 and you only have used 4,000 to this point. So just keep that in mind with this type of trade. All right, so we got 30 minutes left in the day. We try to put these 1 DTEs or 3 DTE in this example out. We try to wait as long as we possibly can, because this market during the witching hour can do some irrational things. We can still go back green in the next 30 minutes. We can go down to double, right? But I think we're going to go down, and it's a coin flipping probability if we're going to go down or up from here, right? I just think we're going to go down, but I'm okay with that, and we're going to put this. I just don't think we're going to go down a lot. So we're going to go here, and we're going to try to collect $100 on this trade. And we're going to go to this 4120, 4100. So that's giving us $50 there. And if we go to this call side, let's say we go to the 7 delta here, that's 4240, 4260, that's giving us 110. So this is the trade here. Right? This is the trade here. We're getting $110. It's only going to use just under $1,900. Right? I said we're allocating 6,000 to it. So let's see if we can get filled on this. But before I'm going to send this, and then we're going to talk. Okay? As the markets just dropped a little, I felt like we're going to drop some, but anyway, let's send that for a second, and we'll see if we get filled. But I want to point out a couple of things. You want to look at, when you're doing these type of trades, we talk about this often, you want to look at what the market is indicating based on the expected move. Doesn't mean it's going to do that, but usually 68% of the time, or 1 standard deviation at a time, it stays within that expected move. So you're giving yourself some wiggle room. I want to do at least 2 times that expected move. So let's just say that is 25. It's more like 26. And then the straddle price is 28. So 28 times 2. I'm going to go with the bigger expected move. So 28 times 2 is 56. So what I'm going to do is subtract 56 from this number, what it's currently trading at, and see where we stand with that. So 4187 minus 56 is 4131. All right, so where are we at there? So right there, we're at the 4120. So we're more than 2 times expected move on the put side. And then just add 56 to the call side. So 4187 plus 56, that's going to take us to 4243. So we're not 2 times the expected move away on the put side. I mean, on the call side. We're close, right? We're close, and we've been going up so much. So I like this trade on both of these on both sides here. And unfortunately, you can see that the market is taking some premium out of the trade at this point, and it's happened fast. So we're not going to be able to get filled at that trade there. But if you wanted to, you can decide to move the put side up a little bit to get what you want. Um, maybe in the next 27 minutes it's going to come up, and I bet you it will. It's going to be more expensive than that, but we're going to see we're going to go with the $1. Okay, $1 before fees and commissions, and just to be able to stay with those strikes that we like. Okay, so even if the market drops another 11 points, we're still going to like this put side here. So we just did that one DTE trade.